Among all the pitfalls that lie in wait for the unwary speculator, there is one supreme error, one fatal flaw that consistently annihilates accounts faster and more brutally than any other. It is a deceptively simple act, often born of stubbornness and false hope, yet its consequences are absolute ruin. I have witnessed countless promising careers built on intelligence and initial success crumble to dust because this single mistake was not understood, not avoided, not eradicated. This is not a theory, this is a hard-won truth forged in the fires of personal experience. If you wish to protect your capital and build lasting wealth, you must absorb this lesson into your very being. To ensure this vital guidance reaches all who seek true market mastery, subscribe now, leave a like, and any comment below. Your engagement ensures this invaluable wisdom serves its purpose. The mistake I speak of is called averaging down. It occurs when a speculator buys a stock, sees its price decline, and then, rather than cutting losses, purchases more shares at the lower price, believing they are getting a bargain or lowering their average cost. This act often feels logical in the moment. The stock is cheaper, so buying more must be smart. Yet this is a profound deception. It stems from a misunderstanding of how markets truly move, and more importantly, how human psychology operates under pressure. It is a trap set by your own mind, tempting you to compound an error. Many fall into this trap because they fundamentally misunderstand what a declining price signifies. They see a falling stock as a sale, a chance to acquire something valuable at a discount. But in the ruthless reality of the market, a price decline usually signals weakness, disinterest, or a fundamental shift in perception that has yet to be fully realized by the average observer. When a stock is falling, it is doing so because there are more sellers than buyers, and this selling pressure often intensifies before it dissipates. My experience taught me this brutal truth. What appears cheap often becomes infinitely cheaper. Averaging down does not mitigate risk, it multiplies it. When you add to a losing position, you're not only committing more capital to a faulty idea, but you are also dramatically increasing your exposure to an already unfavorable market movement. The mathematics of loss are unforgiving. A 25% loss requires a 33% gain to break even, but a 50% loss demands a 100% gain just to recover your starting capital. Averaging down deepens this hole, making recovery exponentially harder. It is, quite literally, pouring good money after bad, betting more on an idea that the market has already declared wrong. The primary fuel for averaging down is hope. The fervent, irrational hope that the stock must recover, that your initial assessment must be right, and that the market must eventually agree with you. This hope stems from a refusal to admit being wrong, an ego-driven stubbornness that views a loss as a personal defeat rather than a simple market signal. Emotions blind you to the objective reality of the tape, trapping you in a cycle of denial. Hope, in this context, is not merely a weakness. It is a direct path to the depletion of your capital and the destruction of your trading career. My own costly education in the market taught me an immutable counter-principle. Your very first decision, your initial action in a trade, must show a profit. If you buy a stock and it immediately begins to decline, even by a small margin, that is a clear signal that your timing is off, or your analysis is flawed. The market is giving you immediate objective feedback that your position is in wrong. This instant validation, or lack thereof, is crucial. If your initial venture is met with a loss, you have identified a mistake, and you must act without hesitation or emotional attachment. The ultimate goal of every speculator is not simply to make money, but more profoundly, to preserve their capital. Your capital is your ammunition, your ability to stay in the game, your lifeline. Averaging down directly violates this fundamental duty. It is a reckless disregard for the precious resource that allows you to speculate at all. You cannot make money if you have no money left to trade. Every decision must be filtered through the lens of capital preservation, and averaging down fails this test spectacularly, turning potential minor setbacks into existential threats. Instead of averaging down, the correct action when a trade goes against you is simple, yet incredibly difficult for the undisciplined. Cut your losses swiftly and mercilessly. Admit you were wrong, exit the position, and preserve your remaining capital. This frees your mind from emotional entanglement and liberates your funds for the next, clearer opportunity. There is no shame in taking a small loss. The shame lies in allowing a small loss to metastasize into a devastating one due to stubbornness or hope. Your goal is to keep your losses small so your wins can remain large. Every loss in the market is a lesson, a piece of priceless tuition in the most demanding school on earth. When a trade goes against you, analyze why. Was your analysis flawed? Did you ignore a signal? Did you violate your own rules? Extract the lesson, integrate it into your future strategy, and then move on without emotional baggage. Do not use a loss as an invitation to double down on an error. True progress comes from learning from your mistakes, not from compounding them. Pay the tuition of a small loss rather than the ruinous cost of stubborn denial. The principle of never averaging down is not merely a suggestion. It is an immutable rule for survival in the brutal arena of speculation. It forces you to be honest with yourself, to acknowledge market signals, and to prioritize capital preservation above ego or false hope. Embrace this discipline, make it an absolute cornerstone of your trading philosophy, and you will eliminate one of the most common and destructive paths to financial ruin. It is through such unwavering discipline that you move beyond mere gambling towards true market mastery.